So Anusha, I want to start because it's like
Yes.
6:05.
Sure, Preeti. I think we can get started.
Yeah.
Good evening to everyone, especially the strong, ambitious women who have joined our event today. I'm Anusha Nyapati, and I'm pleased to welcome you all to the second event of the Emerging Professionals, Get Money Smart. Our aim with this event is to create a 101 guidelines on how to get smart with all the money you make. I would first like to introduce the ever-supporting leader of the emerging professionals community, Ruchita, to share her experience with AFH and give a brief introduction about our community objectives. Ruchita grew up in Pune and graduated as a topper with a bachelor's in electronics engineering from the Pune University. She started in the cellular network planning and development division of Birla AT&T Communications, which is now Vodafone, and held the distinction of being the first woman in the engineering department. After a long gap of 22 years, she staged a career comeback and joined Aspire for Her as head of alliances and partnership. Ruchita builds communities that inspire, motivate, and elevate each other. She has successfully built the biggest community of women in technology called She Dares, which is in collaboration with Amazon Web Services. She is one of those rarest examples that we see on a on a rare occasion where people have actually made comeback after such a big break. Over to you, Ruchita.
Thank you so much, Anusha, for that warm welcome. And yes, it's actually a privilege to start the emerging professionals community. At Aspire for Her, we have a mission and vision of getting more than 1 million women in the workforce additionally by 2025. The reason is very simple. In terms of the Economic Gender Gaps Index, India ranks 4th from the bottom in a list of 146 countries. But if you actually go and look at some of the, you look at the graphs, it also shows that when women pass out of colleges, they are the brightest and the best. They start off early in their careers, they do very well. However, somewhere down the line, they drop out of the workforce, primarily due to the 3 M's, marriage, maternity, and mobility. And we realized that that is where the leaky pipeline was. And because a lot of women move out from the workforce, that is the reason why we see this kind of a declining trend. Hence, we decided to capture it early by looking at women right from their early stage career and maybe a little before that when they just start college, because that's when you can change the mindset. So at Aspire for Her, we not only motivate women to enter into the workforce, but also stay there. With that, besides, being part of the workforce, talking about economic independence, financial literacy is a very big part of the community because women are also not very great in terms of finances. A few are really, really good, but it's not in most of the women. We recently also had one of the sessions which talked about careers in finance. And we had this young woman, I think in the top 100, who talked about her journey that until the last 1 year, it was a husband who was actually doing all the financial planning. And she was, again, one of the toppers of her time and doing some great work, but she never did that. With that, I will just leave it for today's event to be going forward. But I would again like to give a huge shout out to Team Tres Vista. for actually volunteering and supporting us in looking at this community and building it. Thank you once again to all of you. And I really see the enthusiasm with which you come forward. So thanks once again, and over to you.
It's our pleasure to be partnering with the emerging professionals community, Ruchita, to be honest. Without further ado, I would like to introduce the star of today's event, Mrin Agarwal from FinSafe. Mrin is the founder of FinSafe India Private Limited. It's a financial education company in the space of financial well-being. In the last 7 years, FinSafe has impacted more than 1.5 lakh lives to lead a better financial lives. Mrin has more than 25 years of experience in wealth management and has worked with Citibank, Deutsche Bank, Birla Sun Life. She has extensive experience in the investment advisory, banking, debt and stock markets, and is always regularly interviewed by CNBC, TV18, ET Now, Zee Business, Bloomberg Quint. I think the list will go on. She has won the CNBC Grand Jury Prize for work done towards financial education and inclusion in the UTI CNBC Financial Advisor Awards 2015 and 17. But before we actually call on Mrin to take the stand, we would like to understand our audience a little better. I request Vidya to show up the poll questions that we have planned. So the first poll question is, when it comes to managing your personal finances, which of the following is your role? Are you the primary or sole decision maker? Are you the decision maker with another household member or friend? Or is another person planning your finances? The second question would be, do you implement a systematic budget every month? If so, are you able to keep the expenses under the budget? The third question would be, how much do you spend on a monthly basis as a percentage of your income? The fourth question, which I'm sure all of us do, is, do you use your credit card for your payments? Do you pay only the minimum monthly payment or on your credit card dues?
Anusha, should I wait for 10 more seconds for more people?
Yes, I think. Yep, I think we can wait for a few more seconds before we go on. Okay, Preeti, I think we can move on to the session. Thank you so much, audience, for helping us get to know you better. Over to you, Mrin.
All right, that was very interesting. I was looking at the poll results and I see that a lot of people spend around 50% of their income. And many don't know actually how to calculate, how much they're saving or how much they're spending. So that's pretty interesting in terms of the poll results. So good evening, everybody. It's lovely to be here today. And I'm here to talk about how women can actually manage their money better. So shall we start, Anusha?
Absolutely, Mrin. I think one of the few questions that actually revolves around our minds is, what are some of the reasons that women don't get involved in managing personal finances?
I think it's a multitude of reasons. I think there's a lot of stereotyping where women are led to believe that managing money is something that only men can do. And I can tell you that, all my life, all my customers were men, and I can tell you it's not that they knew anything better. It's just this feeling that we have. I also think that women have a lot of lack of confidence when they manage money. They're kind of, not sure if they're doing the right thing. They don't know who to check with. And, they're scared of losing money. And somewhere with all the multitude of responsibility that women have, they tend to basically, leave the money management to the male members of the family.
I agree with you, Mrin. I think even in our families, sometimes we see that our father's handling the finances and the mother's handling the household chores. So we tend to have that sort of a wiring in our head. But I'm sure that's changing going forward. Another thing that I would like to actually ask for our audience is, so how do young women actually start managing their money?
So for women who are just entering the workforce and everything, I think, the first thing is to say that, okay, I have to do this because this is good for my own well-being, right? And, many times what I see of women is that they always believe, at least those who are, let's say, married, for example, they always think that their income is kind of secondary. It's something that can be used for expenses, or it's something that they can just blow up on themselves and stuff like that. So I think, the first thing is to have importance of financial well-being in their life. Like we give so much of emphasis these days to the way we dress, the way we are turned out, or to our physical fitness, right? Because it's very trendy to look fit and to look smartly dressed out and stuff like that. And somewhere we need to give the same importance to financial well-being, because honestly, it's only when you actually start saving early on that you can actually try to reach financial independence. So I think the first thing is to really give importance and say that I can really do this. The second thing is that when you want to start managing money, the worst thing you can do is listen to everybody's advice. Okay. And there's a lot of free advice around in terms of how you should manage money. You'll have family members, friends, colleagues. And if you don't have all of these, today you have financial influencers who are out there putting all sorts of crappy videos, right? And people are listening to this. So first thing, if you actually want your money to grow, you need to stop listening to everybody around yourself. You need to read up and you need to figure out on your own as to what you're going to do. And, it's always a good idea to, ensure, I think, one of the important things for all youngsters is to keep an eye on their personal cash burn rate, right? So how much are you saving every month? That's a very, very, very important number that you really need to look at. It's like, when you're looking at, okay, how many steps did I do this month, for example, right? Or how many hours did I spend exercising? In case of money, it's really about how much percentage of my take home did I actually save.
I completely agree, Mrin. I think even anyone who just starts working should decide what is your monthly pay and should just transfer the money into another account so that they don't spend it at all. I think that's something that I used to do when I started working as well. Leading up to that question, I actually would like to ask, often due to multiple reasons, women deprioritize money management. How can actually women stay committed to that financial journey?
So again, it's all to do with the mindset, right? And, one of the ways to really stay committed is, by having goals in mind, right? Now, you're earning money and then you're investing and you're saying, okay, let me just invest somewhere, maybe I'll buy some gold jewelry and, that'll be good security and stuff like that. No, you need to have a goal post, right? And you need to say that, okay, I'm investing because I'm saving for this goal. This goal could be child education. It could be your retirement, or it could just be that I want to save money so that at a later point in time, I can figure out what I want to do in my life, right? But there needs to be a goal post, right? It cannot just be that I'm saving money and I'm just investing it somewhere. And I think, the moment you have goals and you tie in your money management to goals, it becomes that much more easier for you to remain committed, because otherwise, it's like, okay, I'm just accumulating some money and it is some financial security and everything like that.
I agree, Mrin, completely. So I think one thing that all of us face these days is this BNPL, personal loan, delay in credit card payment. They actually impact not only our savings, but also our investment, because once you actually pay your credit card dues, the amount of take home for the next month actually comes down. It also affects your credit score. Can you talk about what is credit score and how one should be more careful about it?
Oh, yes, absolutely. I just feel that all of these loans are the bane of the society because, excuse me, with a lot of these loans, what is happening is that these are unsecured loans. So there's no asset that you've given, right? I mean, somebody has given you a loan without taking charge of any asset, right? Now, unsecured loans are very high risk loans for any financial institution. And everybody has a credit score that's linked to their past prepayment track record. It's linked to their credit card utilization. It's linked to the number of unsecured loans that you have, because even though you might be paying back on time, the very fact that you have a credit card loan, a BNPL, and all of these actually means that you are a very credit hungry person, or you're not able to manage your life without credit. And that's going to really reduce your score. So why do you need a good credit score? Because later on, when you need that big loan in life, which is the home loan, you're not going to be able to get it if you have a low credit score. So it's really important to maintain a good credit score. Also, I just want to say nothing comes free in life. So, BNPL is positioned as this thing where there's no interest payment. There are many other products, like now I've been hearing about early wage access, which is like, there are companies that will give you early access to your salary and stuff like that. And they say we only charge you a transaction fees. But I just want to tell you that, nothing comes free in this world. So for example, when you're taking BNPL, while you may not be paying any interest, you're not getting any discounts that you would otherwise get. So that's the financial aspect of it. The non-financial aspect of it is that it really makes you rely on these loans again and again and again. So I have heard of people buying everything on BNPL, like you go to a TV shop, a electronic shop, and you're buying a TV. Forget all that. I am hearing of people even buying something of 10,000 rupees on BNPL these days, right? Or converting their credit card dues into EMIs, for example, right? Again, early wage access, and I'm very, very against early wage access, because when I look at the overseas data on early wage access, it actually shows that people tend to take this 2 times every month. Okay, so 2 times in a month they're going to go and apply and say that I want to get money in advance. And again, the downside of this, while there could be a small transaction piece from a financial standpoint, from a non-financial standpoint, you have a bigger issue that you're at the mercy of this, and you're living your life around this. You're just not able to manage your life without these loans. So to me, one is the whole financial aspect, but I think the bigger aspect is that it is leading us to have very, very bad credit habits. And it is making us very dependent on these loans. So tomorrow, if there is a problem, you're going to find it very, very difficult to manage if you have all of these loans open with you.
I completely agree, man. I think one question I would like to add or ask over here is, so we also come across zero cost EMIs like we discussed, and BNPL, etc. But is there maintaining some amount of credit over your salary a good habit, or should one completely avoid credit cards and any sort of credit?
Look, credit cards are per se okay, as long as you're having a 40% credit utilization ratio and you're paying it back on time. The moment you withdraw cash from the card, or the moment you delay the payment, is when you're going to get into trouble. And I just want to tell people out here that the credit card interest is 42%, right? Your salaries don't increase at that rate, and there's no way that you can grow your money at that rate by investing also. So why do you want to pay that sort of interest to somebody just for a small material gain?
I completely agree. So as a small example, what do you think while using credit cards, especially at a younger age, what should their habits be like? Like, should they, what kind of things they should consider for using using credit card?
So it's absolutely fine to use your credit card, but limit your expenses to 40% of the credit utilization. So if your credit limit is 1 lakh, then spend only up to 40,000, right? And of course, pay it back on time. Don't use it to withdraw cash. And of course, ensure that you have regular payments happening out there. See, under those circumstances, credit card can actually be a great boon. Because, you do have a lot of cards with some very good reward points and stuff like that. And one more thing that you have to also be a little careful about right now is the whole digital frauds, because there are a lot of digital frauds with respect to credit cards, with respect to even loans, right? So you have a lot of these loan apps, which are basically very unknown companies, which are giving out BNPL, Insta loans, and all of these. And you have to be really careful of them. I mean, even if you are taking it. So first of all, I think, with respect to any loan, right? You need to ask yourself, do I really need this loan, first of all, right? And the second thing is that the institution from which you're taking the loan should be a good pedigreed institution, not like just some app that you saw and you just downloaded it, right? So like one of the ways to check these frauds is to see if their address is mentioned, and they have to clearly mention which is the NBFC that they have tied up in the back end and stuff like that, right? So even if you have to take a loan, first ask yourself, do I really need it? Secondly, please ensure that you take it from a well-known pedigreed player. And by well-known, I don't mean like, today we hear of a lot of e-commerce companies in the media, right? So that doesn't make them to be credit worthy, honestly, right? So I'll just give you a small example. Like, for example, there was a company that was having a particular product, and a lot of times I get questions about this, and I keep telling them that, just because they're promising you a very high interest, how can you just invest over there? And they said, oh, but this company is very well known. So I said, where have you heard about it? Only in the media, right? And it's very easy. If I have a great marketing budget, I can spend a lot of money on PR. So that doesn't make a company credit worthy or trustworthy.
That's very true, Mrin. I think we spoke enough about credit. I would like to now move on to the investment side of things. So what are the trending investment habits that you see? Are there any red flags in this?
Well, I think the first thing that, and I think, the whole cryptocurrency meltdown is a great story, because it tells you exactly, how greed can bring your downturn, right? And, or if you look at the whole IPO mania that was there last year, right? So one thing I want to tell you, a lot of people got into all these things saying they'll make quick money. There's nothing as quick money. Okay. If you want to grow your money, it is slow and steady wins the race. Always remember, in the tortoise and the hare, it's the tortoise who won, right? And that's the same thing with money management. Okay. You cannot make quick money. Ek do baar ho bhi gaya, then that's like, okay, chalo, luck tha, ho gaya, right? But consistently on a long-term basis, this is not the way to make money, right? The second thing that I want you to always remember is, please invest only with a regulated entity. So again, coming back to the same thing. Oh, but I've heard about this company in the media and they're like all over the place. If you look at the largest cryptocurrency exchange that was there in India, right? The founder was all over the media, right? Every other day, there was an article about this person or about this company, that they're doing this, they're doing that. But that does not make them to be trustworthy. There are 10 crore people who opened cryptocurrency in India. Today, I'm sure most of those 10 crore people are sitting at a loss because they did not exit. And now it's very difficult to exit, right? So, again, I see, for example, a lot of products being sold at 9%, 12% and stuff like that. And these are all startups. And people coming and saying, oh, but I've heard about them, right? Kahin to suna kyun, koi baat kar raha tha. So first of all, if an entity is not regulated, please do not invest, okay? None of the cryptocurrency exchanges were and are regulated. In India, it's not a regulated product, right? In India, a lot of products are there today in the market which are not regulated. So do not invest in those. And the second thing is that before you look at the returns of the product, you need to ask yourself, what could go wrong in this, right? What is the risk that I'm facing in this particular product? How can I lose money in this or not? Okay. And again, what is the background of the people who have started this, or background of the people who are actually running this? So today, for example, you have a lot of stock baskets, right? Now, I can come and create a stock basket and show some great back-tested returns. But the point is that what is my experience in running these stock baskets, right? So these are the sort of questions you need to be asking yourself. And clearly, where you're seeing a lot of herd mentality it's, anywhere that you see that everybody is running after it and everybody is talking about it, it actually means that you should stay away from it.
That's true, man. I think even I've burnt a little bit of my money just on investing in the stocks that were too hyped up at that point. So yeah, I completely agree with that. So what do you think are the best investments that work for everybody across the spectrum?
So I think like simple, low cost, easy to understand is what always works. Anything that's very fancy, exotic, adrenaline pumping, right? Where, you have people showing off saying, I just grew my money by 30% in 1 month. Okay. None of these things are ever going to work, right? You need, again, coming back to the tortoise, who was the stage boring person walking slowly. That is what is going to make your money work. And according to me, that product is mutual funds. The reason I say mutual funds is because you want to look at products that, one, are low cost, two, which can beat inflation. And I think that's a very important factor today that we are not looking at, right? So typically what I see is either people are taking the highest amount of risk or they're taking very low risk. When we're not balancing out in between anywhere. And I think mutual fund is that great product that allows you to invest a small amount. It's very easy to invest it online. Of course, choosing the right fund is very important as per your goals, but certainly mutual funds. And on the retirement planning side, I would say NPS is again a very, very good retirement planning product. So those of you who are actually working in companies that offer corporate NPS, please do sign up for it. It's one of the best ways to actually save for retirement.
True, Mrin. Speaking of risk, there are, like you said, there are a lot of financial people who actually give advice on Instagram, let's say, and they talk about how at a young age, you're supposed to take on more risk. What would you say to someone like that? And what should the rationale be like?
Yeah, there are all these thumb rules around saying 100 minus your age. And then you've got I saw an influencer video where the person was saying that in 20s, this should be your allocation and, you should do this and you should do that. So I want to say this, that in personal finance, one size doesn't fit all. And the reason being that your goal, your goal and my goal is completely different. So you might be saving money for something that's 3 years away, and I might be saving money for something that's 10 years away, right? So, so both of us could be in the same age group, right? But if our goals are going to be different, then how is it that, that we can have the same sort of allocation to equities? We cannot, right? So everything, your entire allocation is dependent upon what are your financial goals and how far away are those particular goals, right? So certainly I'm not in favor of financial influencers. And I think the regulator is also looking at regulating them, because please remember that when you are listening to a financial influencer, first of all, the person is not certified to give you advice, right? And at best, the influencer is only sharing something that might have worked for them. But please remember that their risk-taking ability, maybe the amount of money that they have to invest, is going to be very different from what you have. Right. And maybe their goals are very different from yours as well. So, and I think the main thing is to remember that they are not certified financial planners, or they are not advisors out there to be doling advice to people at large saying that, okay, do this with your money or do that with your money.
I agree. I think because they literally have almost no stake in the returns you make, you shouldn't be listening to them. I think speaking of that, so we get to, obviously Instagram is one place that people actually scroll a lot, but if one had to actually look at learning resources to educate oneself on what kind of investment should be made, what should be my goals, etc., what would be the best learning resources that are available for young women to learn about personal finance?
So honestly, with all humility, I'll say this. I have a blog on my YouTube page, which is FinSafe India, where I have taken people through the steps of investing. And this is meant for beginners. There are about 40 vlogs. Each video is 5 minutes each. And of course, it's on YouTube. It's free. It's very practical. The whole idea behind this is for you to know where to start, and it's sequential in order. So it's like tells you where you need to start, and how you need to go through each stuff. And of course, it's in the Indian context as well. So that's one learning resource that I would certainly tell women to go to. The second thing that I would always say is that build a habit of reading one of the financial dailies and reading the personal finance column in one of the financial dailies to keep yourself aware of what's happening in this space. And you do need to keep yourself aware of this because it's affecting your money, right? And at the end of the day, we all need money to live. So I would certainly recommend that, take the subscription of one of the financial dailies and make a habit of maybe, couple of days going through it to see, what's happening and keeping yourself aware of what's going on. I would say, and I personally like Money Control, and I do recommend, although I do write a monthly column for them, but I write a monthly column for a lot of people, but I do recommend Money Control because I find that their columns are easy to read and easy to consume for lay investors.
Good to know, Min. I think all of us should start following Money Control, your column on that,
Yeah, but you can,
especially.
please, there are many others. There's Mint, there's Economic Times, Business Standard, Financial Express. So please choose whatever, Hindu Business Line. All of them have very good coverage.
Perfect. I think one question that I would like to ask is we keep hearing how small caps are making so much more returns compared to blue chips, but then they also have higher risk. So I think it's a little confusing for anyone who's starting off, right? So what should their approach be like? How should they even take a look at the equity market if you want to?
Yeah, that's a great question. So first and foremost, when you are investing into equities, I would say take the mutual fund route and not the direct stocks. There's 7,000 stocks in India. How do you figure out what to buy, when to buy, how long to hold it, when to exit, right? Majority of people buy based on tips. So please stay away from direct stocks. You have a great investment with equity mutual funds that is available at a very low cost. So now there are different types of funds. You've got index funds which track a particular index. You've got flexi cap funds which invest a little bit in everything like large, medium, and small size companies. You've got mid cap funds which do basically medium sized companies, and small cap funds which buy small companies. Now, the mid cap and the small cap companies are certainly much more volatile, right? And hence, first and foremost, the first point to remember in equity when you're investing. So first was about investing in funds. The second point to remember is that whenever you're investing in equities, you need to have at least 7 to 10 year time frame, right? So, in a 2 to 3 year time frame, which is what most people invest for, it is very difficult to make money. And markets can be extremely, extremely volatile, right? Like, so who would have thought in a year like this, where we had a global geopolitical situation, where you saw globally inflation going through the roof, interest rates going through the roof, would you have ever thought that Indian markets would be at their all-time high, right? So, given the fact that we really do not have any control about how markets are going to do, what you can control is where you invest, how much, and for how long, right? So if you are investing in equities, you need to be in it for at least 7 to 10 years. And in terms of risk, your index funds are lower risk compared to the mid cap and the small cap funds. The mid cap and small cap funds are going to be more volatile. But yes, point to remember is that you can lose money across all of these funds. Your capital is not guaranteed. The returns are dependent on how the markets do, but the index funds carry a lower risk as compared to mid caps and small caps. But in the long term, the mid caps and small caps give you better returns. So I think it's like a risk return trade-off, depending upon, how much risk you want to take. You can actually build a blended portfolio of an index fund and a mid cap fund and a flexi cap fund, and that's enough for you to really start.
Thank you so much, Bren. I think one more question I would like to ask for me personally is, let's say if we have like a 3 to 5 year time frame, should people consider investing in debt mutual funds or commodity mutual funds or something which has a mix of all of them?
Not commodities, honestly, I do not believe in, buying a commodity fund. I mean, if you do want to buy gold, and since we, this is a session for women, certainly I'd like to talk about gold. Gold jewelry is a terrible form of investment because you lose out 30% and all this making charges and whatever the overheads that are being charged, right? So that's not a great investment. And especially if you're buying diamonds and stuff like that, there's very little resale value. So if you do want to invest in gold, I think the sovereign gold bond scheme is a great way to invest into gold. It's zero cost. There is an 8-year lock-in, of course, but the returns are also tax-free. So I think it's a great way to invest. And as far as 3 to 5 year holding goes, yes, you can look at short duration debt funds, for this particular requirement.
Understood, ma'am. I think these were the questions we had at our end. Let's see if we have some questions from the audience. Preeti, do we have any?
Yeah, so I do see a question from Shreya. So Shreya, would you like to unmute yourself and ask your question to Mrin?
Or maybe we can read it out if there is some internet connection.
Yeah,
at
I'll
our
just
end.
check once more. Shreya, are you there? Would you like to ask your question to Mrin, or would you like us to read it out? If you would want to, you can unmute yourself and ask the question. All right, I'll just ask her question. Yeah, so what Shreya wants to know is, what are your views on investing in large cap versus small cap stocks?
So as I said, that I don't believe in investing in stocks directly because we don't have the knowledge and the information to really make the right decisions in terms of what stocks to pick up. And especially in case of small cap stocks, the sort of due diligence that you need to do to actually buy a stock is very high, which I don't think, as individuals, we have the bandwidth to do so. So, firstly, I would say buy a fund. Now, between a large cap fund and a small cap fund, it really depends. If your holding is for more than 10 years, you're willing to take risk, you're not going to be perturbed by volatility, then I would say go for small cap because it's given the highest outperformance versus the index. So, I mean, I would certainly say small cap, but it'll be a very, very volatile journey. And you really need to have a lot of patience to, remain invested.
Understood, ma'am. I think I got a question personally on WhatsApp. This is more to do with, could you elucidate the risks involved in the NPS retirement scheme? And also, should the NPS and ELS scheme be restricted to only, let's say, 1.5 lakh of the ATC that's actually tax-free?
So, I'll tell you what the risk on NPS, I think, when you invest in NPS, I think you need to be very clear about two things, right? The first is that you're investing into it because you want a pension in retirement, right? So I think, as long as you want that, it's a good scheme. So if you ask me what's the downside in the scheme, the only downside is this, that I may not want to get it as pension in retirement, in which case it's not a scheme for you, in which case you have a plethora of mutual funds that you can invest into, right? Now, the NPS is the tax deduction on NPS is over and above ATC. So ELSS comes in ATC, but you have an additional 50,000 in NPS, which is over and above the ATC.
Understood, ma'am. Preeti, do we have any more questions?
As of now, I don't see any other questions that have come. Probably we'll wait for a couple of minutes. So I had a question from Ren. So more on in terms of how do you better prepare for the financial emergencies? If you could throw some insights around that.
Yeah, so I think it's important to have 3 to 6 months of your expenses kept aside. I think the easiest form to do it is to keep it in a fixed deposit, because fixed deposit is very easily accessible at a time of need. So 3 to 6 months of your expenses, you can build it up over a period of time. And just ensure that you keep contributing, and if it gets used up for any contingency, then of course you have to rebuild it again.
Thank you.
Got it, ma'am. I think we
see
have another
one
question. Yeah, sorry,
Yeah.
Preeti, go ahead. Yeah.
No issues. So there's a question which is around, Niyati is asking, what are your thoughts on SIP?
Oh, it's a great instrument to invest in. But see, one thing I want to tell you that it's not like a magic wand. You need to get things right in SIP also, right? So there are two things: which fund do you choose, right? And how long do you remain invested? So these are two very important factors in the SIP. So just to give you an example, like if you choose the wrong fund, let's say you chose like some sector fund, which hasn't done well, like for example, healthcare, right? As a sector hasn't done well, although, you would have thought in 2020, you would have invested in healthcare thinking that it's a great sector to buy, but actually 2021, 2022, it's not done well. So the point is that you need to choose the fund rightly. And the second part is that you need to be invested for the long term. Again, SIP is not going to work in a 2 to 5 year period. You need to invest in it at least for a 7 to 10 year period in order to get good returns. And what I mean by that is not only do you keep doing the investment, but at the same time, in case of volatility, don't exit. So the moment, people see markets down, they have this tendency to exit the SIP. And that's something that you should certainly not do. In terms of how do you know which is a good SIP to buy? Well, again, you can refer to the FinSafe website. We've put out a list of funds based on quantitative analysis. You can also check out Morningstar.in, which is the global leader for mutual fund research. They do have a list of recommended funds, and they've got various tools on their website that you might want to check out.
Understood, Mren. I think this is one question that I would like to ask as a follow-up. So let's say if one shouldn't focus on an industry or a sector specific fund, should it be like very sector agnostic? Or if let's say one is very ambitious or like wants a risky investment, let's say, because they want to invest for the long term, should they actually allocate % of their portfolio to, let's say, a particular sector that they're bullish on?
I wouldn't do it. And I'll tell you why. Because in any case, if there is a particular sector that's looking good, or there's a stock that's looking good, it would be there in the regular portfolios, right? So you would find it in a flexi cap fund, for example. I just feel like, taking these very concentrated tactical calls is more for institutional investors, right? And so I wouldn't do that. In fact, if you can take risk and you can hold for the long term, I think you should buy a actively managed small cap fund.
Got it, Mren. Thank you so much, Mren. Preeti, do we have any other questions?
So I don't see any other question as of now. So I wanted to ask Mren, if you could throw some light on, I think this would be on, a lot of people's minds here, that if you're looking at kind of minimizing the taxes that you pay on an annual basis, are there some tips you can provide around this?
I think everybody, of course, you have ATC that's available, 1.5 lakhs, and then you have like NPS over and above that. And then you basically have the home loan sections, and you have the medical insurance premium. All of this, I think at the maximum adds up to about 4.5 to 5 lakhs. So taking into account standard deduction and all of that, right? Beyond that, it's honestly not, there's nothing else that's available to get deductions.
Thank you, Mren. I think these were our questions from the audience and from our team also. And thank you for being so patient in answering all of our questions. I think our audience has now understood how to get smart with their money. Now
so
we come
Anusha,
to... Yes.
I'll just interrupt you. So our Aspire for Her founder, Madhura Das Gupta Sinha, is there here. So I will just invite her to say a few words about the community and about Aspire for Her. And
this is so amazing, and I'm sorry I got a little delayed. And Rin, I have heard such great things about you, and thank you so much. Thank you so much for being part of this. And I know that all our Aspire for Her leaders here, Simran and Preeti, and I think we consider the entire Trust Vista team as part of Aspire for Her itself. They are leading a community, building a community with us. I think you sort of interaction with them, but the part that I caught was absolutely outstanding, amazing. And I think there is a lack of this kind of conversation, in young professionals, in all stages, but more so in young professionals. That's why the emerging professionals community they actually, when they decided that one of the things that we are going to do for this community, financial literacy and financial education came up right on top. So I am very happy to see all my friends here, Aditya, Gautam, Anusha, of course. And thank you so much. Yeah, I think, this kind of conversation is what will drive better decision making. And in India, we know that financial literacy rates are equally bad among men and women. So it's just a very, very small gap, in fact. But we do realize that more men are forced to take those decisions because of a variety of societal conditionings, and they take the decisions even though the literacy may not actually be right at there. So it is people like Mrin who will help us. And Mrin, we'd love to have more of you in Aspire for Her. In various different parts of Aspire for Her. As you know, we have 15 communities, as all of you know. The last one was a women leaders community that we launched, and we have a women in boards program happening over there. But for financial literacy, Simran has been brilliantly running this across all the communities, because we are very sure, we are very certain that this need is not about just one community. It is about every community in Aspire for Her. So we'd love you all to, spread the word. We'd love you to spread the word in your space as well, because we don't only talk about financial literacy. We're all about women and careers. We want to add 1 million women to the workforce by 2025, 10 million by 2030. And as they enter the workforce, they need to be smart about their finances. And therefore, you will have a lot more women to talk to. And we hope that happens sooner than later. So that's what we do for a living. And I just wanted to say thank you for coming in here, Mrin. And we're very, very happy to, we will be very happy to see more of you at Aspire for Her in the coming weeks, months, years.
Thank you. Thank you so much, Madhura. It was a pleasure to be here.
Thank you. Thank you.
Thank you so much, Madhura. And thank you so much, Mrin. As always, Madhura, it's amazing to hear you talk about Aspire for Her and about our community objectives. And I'm so glad we could play a part in it. And Mrin, thank you so much for actually helping us help your objective move a little bit in the positive direction. And like Madhura said, we'd actually love to have more of you and more talks about financial independence within our community as well. So specifically among the Aspire for Her community, I think Ruchita, Madhura, Preeti, and the entire Aspire for Her family has helped us actually make this event successful. So a shout out to them. And within the Dressustar team, of course, it has been Gautam, Devna, Mehak, and Aditya. And thank you so much, team, for actually helping us make this event successful. We encourage all of you to join our community of emerging professionals. The link is shared in the chat box, and keep following our upcoming LinkedIn page and Insta handle for more events and opportunities that might come your way. Thank you all for joining us, and we wish you best of luck and hope to support you with all the heights you plan to achieve in your professional life.
Thank you so much.
Thank you.
Simran.
Thank you so much.
Thank you,
Mrin.
Simran, for doing
Thank you,
this.
Simran.
I think this is a very important part of everybody's education. And keep aspiring for her, guys. Thank you.
Thank you, Mrin.
Bye.
Thank you, Anusha.
you.
Thank you. Bye.
Bye.
Thank you, everybody, for joining in.